I'm going to show you guys exactly how you can make $337 per day from yield farming through decentralized finance. Let's hop in. So essentially, we have 5 different concentrated liquidity pools on this list that are yielding $337 per day. That's a 130% APR. The other thing I want to go ahead and mention is we are managing our risk through this portfolio. We're not allocating too much capital to something that can just snap just like that. I will go ahead and break down the risk associated with each position as well and do an analysis. So let's hop into that. Now, the first position is going to be Ethereum to USDC. Right now, the returns on Ethereum to USDC are pretty absurd. They're really good because there's a lot of people trading Ethereum right now, as well as trading USDC. The market's going up, the market's going down. That creates trading volume, which creates fees for you to collect as a liquidity provider. Regardless of if you're going up and if you're going down, as long as you're structuring your pools properly, you will be outperforming if you were to just hold your money strictly in Ethereum or strictly in Ethereum and USDC. So obviously, with all of these different liquidity pools, you're going to have risk to the platform you're providing liquidity on. One thing I want to mention is Uniswap has not had any issues in all time that has been in business since 2018, and it's the largest decentralized exchange with over $3 billion of capital invested into it. Now, the other thing is the assets that you're taking exposure to. So right now, Ethereum is down 6.6% on the day. Pretty bad. We're retracing exactly the price pump that we've seen over the past 7 days. The thing is, when we zoom out, we look at 90 days, you'll see that what we're seeing right now is completely healthy. We saw the same thing back over here where Ethereum hit 2110. It retraced all the way down to about 1920 before pumping all the way back up to $2,400. I personally think the market is relatively overvalued right now. I think the retracement that we're currently seeing is completely reasonable, especially for the price action that we've recently seen as well. But using builder metrics, we can determine what type of return we're going to have, as well as what type of range we should use for this liquidity pool. This one is on the Ethereum network because it does return more on the Ethereum network. If you go to the Arbitrum network, the Polygon network, the Optimism network, or any other network, ETH to USDC is not going to be doing better than it is doing on Ethereum mainnet. I know that because I checked them all, but it's also on the 0.05% fee tier, and we're using a range of 1950 to 2700. One thing I want to mention is if you are ultimately bullish on Ethereum in the short term, you think this retracement is just a minor retracement and it's going to shoot back up, structure it with 1950 to 2700 range. The reason why is because you're allowing a lot of upside exposure. You're putting up a lot of Ethereum at the start, so that way you can sell into USDC as the price moves up. You're not giving much room for downside exposure. Whereas if you're ultimately bearish on Ethereum, you think Ethereum is going to go down in the short term, so you might want to structure something quite the opposite, where maybe you do 2450 on the top and then something like 1750 on the bottom, ultimately giving you more downside exposure. That's still going to yield you roughly 60%, just like this one's yielding you 57% a year. But with the $25,000 allocation, you're making $40 per day off of this concentrated liquidity pool. I will say this one would be worth it because it's on the Ethereum network. Yes, you're going to pay high gas fees, but you're still making $40 per day, which is $14,000 per year if you keep this up. Now, personally, I wouldn't allocate too much capital to stuff paired with USDC, because as soon as those assets start to rise, well, then you're getting sold into USDC, and the last thing you want is to be sold into a stablecoin when the other asset is completely pumping. So that's exactly where Ethereum to Matic comes into play. This one also on the Ethereum network. It does better on the Ethereum network than it does on the Polygon network. It's also on the 0.3% fee tier, yielding 68%. Now, one thing I want to mention is I was in this pool for a very long time. I made about $3,000 on this pool in the time span of just a few weeks, which was great. Now I got out of this pool, which is exactly why I'm including it on this list. This one has more of a short-term range, which is why I got out of this pool. The range that I was using was making me roughly 35% a year. I was wanting to shoot for 45 to 55% per year. So obviously the return just wasn't there for me. Now the thing is, if I went with a tighter range, something like 2300 to 3000, which is just a little bit more aggressive and means you have to spend a little bit more time, you're going to get a 68% return, which I would be perfectly happy with. That means off of $25,000, you're bringing in 17 grand per year, which is $45 per day. The reason why I didn't just rebalance my pool to something like 2300 to 3000 is because I am not that active in my personal pools. I spend more time working with clients and helping them establish portfolios than I do actually manage my own portfolio. And the reason why is because I believe in passive income, or at least semi-passive income. If I can do maybe an hour per week of work on my personal portfolio and then help other people build out their portfolios, I'm happy with that because my portfolio is still making me roughly $1,500 to $2,500 per month completely completely passively, but I also have income from helping people establish their own DeFi portfolios. As you can see, I was running Matic to Ethereum with a few different positions, and I came out to an overall profit of $4,100 in the time span of just about a month of being in these different positions. Now, if we benchmark it against if I just held my assets in the market, I still came out to a $2,250 profit. So I profited against somebody that just held their money in Ethereum and also held their money in Matic, which is great. And that's exactly why liquidity pools are such a great concept and such a great investment opportunity. It's like being paid dividends for holding assets that you would already be holding as long as you're doing the right strategy. And by the way, we have a business called Builder Wealth where we help you establish your own DeFi passive income portfolio. This is called the DeFi Accelerator Program. There's more information down below in the description. But obviously the underlying assets are Ethereum plus Matic, so those are the assets that you have risk towards. If Matic goes up and Ethereum goes up, well, you make money. If they both go down, you lose money. If one goes up and one goes down, well, then you're probably going to go out of range. It's important to structure your pools properly. I cannot stress that enough. Now, the next thing we have on this list is also on the Ethereum network, also on Uniswap, and I promise we're going to get into a pool that's on a different exchange in just a second, but this one is Ethereum to FET. Now, I was in a FET pool all the way back in February of this year when we launched Builder Wealth, and I also had our first client in the FET pool. We were making roughly 10% per day because the return was so good. Now, obviously, the return has died down. FET had a period where it wasn't doing too well, but so was the entire crypto market. And now FET's doing pretty well. It's up about 15% over the past 30 days and down about 5.6% in the past 24 hours, along with the overall crypto market. If we zoom out and we look at the past 1 year for FET, it's also pretty healthy. As you can see, it was doing really well at the beginning of this year in February, and then started to decline throughout the summer of this year, and then just started to pick back up around October and start to witness some really good returns for investors in this liquidity pool. Now, something I really like about the Fetch AI and Ethereum liquidity pool is, number one, Fetch AI has a market cap of $500 million, which means it is a relatively risky asset. Granted, 500 mil is 500 mil, but compared to something like Ethereum, Bitcoin that have multi-$100 billion market caps, it is, a pretty risky asset, I would say. So you do have some volatility here. But of course, that means that we are on the 1% fee tier this time. So if there's $100 in trading volume, there's $1 collected in fees, as opposed to being on something like 0.05%, whereas when there's $100 in trading volume, you collect 5 cents. So obviously returns will just naturally be better because it is on a higher fee tier. This is with the range of 2,900 to 5,400. So if we put our range over on Builder Metrics at 29 to 54, you can see we're getting roughly 200% a year. And there's still a TV of $2.5 million with average daily volume of over $600,000 and average daily fees over $6,000. Volume history is relatively consistent, although it has gone down a little bit in the short term. So you might want to take that into account and determine, hey, maybe instead of getting 200%, I might be getting 175%. But if there is a period where Fetch AI picks back up once again and it sees some good volume days, well, then it's going to even out to that 200% annualized return. So the $20,000 investment is making 200% annually. That comes out to roughly $40,000 a year, which is over $100 per day. Moving further, we have our first Arbitrum pool. This one's on the Arbitrum network on Uniswap. It is ETH to Winner. Now, obviously, your risk here is taking on exposure to Winner, but you are being compensated with a 280% APR. Winner has a market cap of $16 million. It's currently down 16.6% on the day because it's naturally more volatile than all these other crypto assets. When you look at it in retrospect, over the past 30 days, it's up 35% because it just swings a lot more than some of these other assets. Once again, being compensated on that 1% fee tier. So every $100 that comes in, that's $1 in fees that is distributed across liquidity providers. Something I will mention is this pool does have a $400,000 TVL, which means you can't just go throw 100 grand into it because then your 100 grand is making a lot lower return because you are diluting that pool. So with that being said, if we have a range of 18,750 to 38,500, that's going to yield us that 280%. As you can see, it encapsulates the last 30 days worth of data, which is great. That means that we are expected to continue to stay in range for hopefully the next 14 or so days. Volume history is nothing but great, I would say. You could see it's relatively consistent at the start before picking up a ton and seeing a huge volume period recently. So that means you're actually probably going to get more than the 280% return, at least at the start, as long as we keep up with this volume. But as that volume starts to even out and go back to numbers that it was back over here, well, then ultimately that's going to get you that on average 280% return. One thing I will mention is TVL has picked up over time, meaning more and more liquidity is coming into this pool because more people are investing into it. So a $10,000 investment is making making you $28,000 per year. That's $77 per day. And the last pool I want to take a look at is Ethereum paired with ARB on the Arbitrum network. This one's on Trader Joe. I did have to estimate it around 155% because we do not have Trader Joe on Builder Metrics quite yet. We have an allocation of $15,000 into this pool. It's a range of 1975 to 2075, which is relatively aggressive, so do keep that in mind. That's a yearly return of $23,000, which brings you to roughly $64 per day. Add all of those numbers up, your $95,000 making 130% APR is a yearly return of $123K, $337 per day. One thing I will mention is this is relatively aggressive, and you are going to have to constantly adjust these pools. You will have to replace some of these pools because the yield can go down. This is not guaranteed money. This is not risk-free, but this is an opportunity to put your crypto to work if you truly believe in some of these assets. Do not just go throw your money into these pools if you do not believe in the underlying assets. I'm not going to invest into something like Ethereum and Matic if I do not believe in both Ethereum and Matic, and I don't mind being all in on one of those assets or all of my liquidity being shifted to one of those assets. Concentrated liquidity pools are a gold mine as long as you know what you're doing, so it's important to make sure you have proper training before getting into these concentrated liquidity pools, because yes, the returns are shiny. They're like a big diamond just dangling right in front of you, but the thing is you can't just go grab that diamond without knowing what you're doing. If you enjoyed this video and you guys want more videos like this displaying different opportunities in the crypto space and the DeFi space, make sure to drop a like and subscribe when notifications turned on. Remember the link to Builder Wealth down below in the description if you guys do want to check that out. We only want serious individuals, so don't go over there if you guys are not serious about DeFi. I look forward to seeing you guys in the next video, and peace out.